You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
All right, thanks for everybody getting back in the room for our next panel, Options Liquidity in the Face of Changing Regulation. Clearly, risk is around us at every corner of this industry, yet there is one person who manages this risk for all of us. John Fennell is Executive Vice President and Chief Risk Officer of OCC. He leads today an important panel discussion on options liquidity in the face of changing regulation. Please welcome John and the panel to the OIC stage.
All right, good morning, everybody. Thanks for being here. We are talking about options liquidity in the face of changing regulatory environment. Couple things before we get in. You guys have the apps, and if you want to submit questions, you can do it two ways. You could either submit the questions through the apps or raise your hand. There are folks with microphones walking around, so happy to take those as well. We've got a great panel today, and to kick this off, I'm going to ask the individuals to just give them a brief introduction of themselves. Steve, you want to start?
Sure. I'm Steve Crutchfield. I'm head of market structure and electronic trading strategy at CTC Chicago Trading Company, which is a cross-asset options market maker.
Good morning, everyone. Mauricio Izurieta. I work at Equity Asset Management Services at Bank of America Merrill Lynch, covering our financing and clearing business.
My name's Dennis Davitt. I work at Harvest Volatility Management. It's a $13 billion asset manager. I run about $1 billion in that sleeve under the institutional side.
Great. So we're going to kick right in here. And I think the first question we wanted to try to cover off is, we spent 2017 completely low vol environment. And then out of nowhere in February, we get this unprecedented vol move. What, from a liquidity perspective in the options market, how did the options market absorb that and respond? Dennis, do you want to kind of give from the buy-side perspective?
Yeah. One of the things I tell people is in the last 18 months, we've seen a volatility, a third standard deviation move in volatility. And if I ask them if they know what that event was, they'll often look to February 5th. And I correct them and say, really, it was all of 2017. All of 2017, we saw some of the lowest volatility we'd seen since airplanes had propellers on them. So how did the market handle volatility? February 5th was an issue. It really was an issue as far as not so much the trading. There's a bid-ask for everything. But the concern that we had was the settlement procedure at the end of the day. So moving into what I consider now a more normalized volatility market, out of the outlying event of 2017, volatility is back to normal. Liquidity, I think, is good, return to normal. But I will say that transition from a 9 VIX to a 17 VIX over a 2-day period was very trying in the liquidity and the settlement space.
Mauricio, from a bank's perspective.
Yeah, I think as a clearing firm, for us, obviously, more volatility, more volume, that's obviously welcome. And I think, the perspective from a trading firm or a buy-side firm, I think is a lot more interesting that we have to say from our business. But evidently, we've heard a lot as to what happened, how it happened, whether it was right or wrong, whether we're in a new regime or not. For us, I think, just back to normal in a way. We've seen that, a low vol environment hurts everyone in certain ways. And more than anything, I just think we're going to spend some time talking about potential issues from rules and regulations if we have another event like that. So I think that'll be the more, at least from our perspective, the more interesting view.
Yeah. And Steve?
Yeah, I agree. I think, if you look at the way the markets functioned on February 5th, from the standpoint of the options markets, they function correctly. OCC continued to serve as a counterparty for trades. We don't have counterparty risk. The markets generally functioned well. There weren't large trade break or bust and adjust events that I'm aware of, as happened in some of the past events, such as the flash crash in 2010. So from a micro standpoint, I think the market functioned fine. Echoing what Mauricio said a moment ago, a concern that we have as market makers is more about the macro picture. And some of what we saw on February 5th and 6th and since is a culmination and a continuation of a constrained liquidity environment. And going back and looking at some of the data that Henry shared yesterday, where you've seen bid-ask spreads as a proxy of the cost of liquidity generally going through a secular uptrend over a period of time, that continued. Another stat from Henry yesterday, we saw a very large spike in SPY options bid-ask spreads that greatly exceeded by an order of magnitude the increase that we saw in the underlying. Now, there are good reasons for that. Options market makers have other risks that they're taking on beyond just the delta risk that's reflected in the uncertainty in the price of the underlying asset. But generally, we continue to operate at a macro level in a strained liquidity environment for a number of reasons, most notably in our view, led by difficulty of access to capital for market makers today.
So with that context, right, the capital constraints, if February 5th would have happened on a different day, say the end of the month when you got to report capital, how could that have changed the outcome of what we have actually observed on February 5th if it happened 5 days earlier on January 31st?
Yeah, so I'll talk about the capital environment for a second, and then I'll answer that question directly. So as many of you are aware, and Craig appropriately highlighted just a bit earlier this morning, the issue that we're dealing with is well-intentioned regulation that sort of inadvertently went the wrong way and has had some very severe unintended consequences. And in particular, we're talking about, there are a variety of kind of jargony acronyms thrown around for this issue, but we usually refer to it as the RWA, or risk-weighted assets issue, and that the risk-weighted assets number that goes into capital calculations for bank-affiliated clearing firms, which Mauricio knows much more about than I do, is done on a gross notional basis that doesn't allow for the netting of offsetting positions that everybody in the options industry would agree clearly should be deemed to offset. And an example that we use, which is just a very standard, anyone can do the math, the formulas aren't that complicated, but if you take a look at, I happened to pick a $5 put spread in SPX with about a month to go. I think it was 22 days to expiration when I looked at it, trading at a couple of bucks. And so 100 lot, the maximum exposure that one has from being long 100 lot in this thing would be $20,000. If you apply the RWA methodology, the capital charge for this position would be about $450,000. So it's just bad math. It doesn't make any sense. There's no reason that anybody should have to account for that position with that much capital, but that's the world we're living in. And ultimately, it poses severe constraints on liquidity providers, particularly but not exclusively in the index space. It's something that applies equally to all equity and index assets. So these capital requirements apply across the board at all times, but are assessed and looked at a bit more carefully on a month-end basis. And so getting back to your question, I think from a customer experience standpoint as an industry, in ETF options and index options, but also more broadly, I think we really dodged a bullet. If these severe price and volatility dislocations had occurred on February 27th and 28th, or January 30th and 31st, rather than a week later, it would have been much more difficult for some of the larger liquidity providers in the S&P 500, in the in the equity index option space, to provide the same degree of liquidity that was provided, that led to a market that seemed to function relatively normally, even though vol was moving in an unprecedented way.
Yeah, I couldn't agree more. I think it's night and day between the beginning of the month and the end of the month, and even more so quarter end. There are many reasons for that, and just summarize it as saying, as a clearing member, as a bank-owned clearing member, we assess RWA at the end of the month for all our clients. Certainly, this happening on the first week of February, it very plainly put, it allows a market-making firm or a liquidity provider to actually manage their footprint throughout the next couple of weeks. if this had been a couple of days or a couple of hours, that's a very different scenario. And I think when we talk about the true risk to people like Dennis and his firm and the investing community, we haven't seen the impact yet, and it could be an impact that will be greatly felt if certainly a firm can't provide liquidity, as Steve's pointing out, in the S&P 500. And just because you can't trade index options doesn't mean that you're going to go out and find another product with liquidity. I think that's not how it's going to go. It will permeate to other products, and it could be a very bad event liquidity wise. I really like Craig's definition earlier of this gross notional versus net risk. Yeah. Because we've been in the market making space for a long time. This is an important business for the bank. And generally, a market maker portfolio has very low net risk, and they're viewed as such. And history, will tell us that, in crashes in very difficult markets, market makers will generally do well. And when we have to actually hold a lot more capital for that portfolio with very low net risk that generally does well in a crash scenario. It doesn't seem appropriate at all.
Yeah. OCC is the Foundation for Secure Markets. One of the things we're really sensitive to is looking at the health of the ecosystem all the way through the chain and the value chain, and ultimately down to Dennis's position at the buy side. Dennis, when you start to consider the impact these capital charges are having at the execution level, down to when the value proposition of you either going in a listed market or having to take a transaction in the over-the-counter market, how do you see the health of our market now, and what decisions you end up making from an investment perspective?
Well, one of the things the money that I run is we are a daily liquid hedge fund replacement vehicle, and being daily liquid is paramount. Having no counterparty risk, or effectively no counterparty risk, is another selling point for what we do. I will say February 5th, from the buy-side point of view, would have been a real disaster if that was month-end, outside of capital charges or anything. Because as my career was, I was a SPX trader, and then I traded for Credit Suisse for a number of years, and now I'm in my current role. So having seen all three levels of, down to the market-making margin requirements up to the level I'm at now, the thing that was shocking to me was the inability to get settlements. So this is away from risk-weighted assets and a lot of that stuff that I dealt with in my former life. But if you have somebody who's redeeming out of a fund, so if you have a mutual fund, and as we're trying to grow the business, and I'm speaking about this because you said what's the ecosystem of the business, I think we have a real problem. I think had that happened at the end of the month, we would have set back any sort of growth, any sort of the investors that I'm speaking to that have a very basic understanding of options. It would have been a real disaster if they had redemptions or people adding and they didn't know what price to add or redeem them in or out of their fund. And it would have just been a headache. Then you have the ETF complex, the exchange-traded note complex with the leverage in it, was the easiest banner for, as an industry, our competitors, right? So other people who are saying, don't allow derivative products in your portfolio. See, here's an example. And they'll roll out, the XIV or the SVXY or these products. Like, those are hard things to come back from. So the ecosystem is, we need to make sure it's liquid. We need to make sure that people can have reasonable markets to trade. And I think we've moved back towards that, but that February 5th was a really one of the scarier events I've seen in 35 years of doing this, because fortunately our mutual fund complex at our firm is small and growing. Had we had additions or redemptions in and out of the SPX, that was a real problem. What's this option to settle that? Settlements weren't produced. Markets were zero bid at 100 across all sorts of different strikes.
Yeah.
And one last thing is, I'm a firm believer that we need to allow profitability in the market making, what I call risk transfer agents, be it a high-frequency trader or a market maker or some sort of floor trader or whatever they're called, DPMs back in the old days. I think this drive to zero bid-ask and making it more efficient at the end is going to hurt the business overall. If you look at single stock options, which we don't touch, that's a problem. So I still think liquidity is, I think we have a real problem. And I know for a fact that the OTC market is right there saying we will make a market. We just can't fall victim to a stereotypical derivative, rumor and then have it be true.
Yeah.
Yeah, and sorry. Nothing. Yeah, talking again about the month-end issue, we saw in January some market makers who had material problems that were explicitly driven by capital constraints, providing liquidity in index options. We had one market maker who had to be closing only on January 31st due to bank-imposed capital constraints. There's another market maker that had to cut the amount of liquidity they were able to provide by more than 50%. They have alleged. You put that together with some of the points Dennis raises, certainly end-of-month, end-of-quarter issues are more severe, and their risk of becoming even more severe now by putting all these issues together. And I spoke a moment ago about a secular trend in liquidity being more constrained generally. So we saw that in some data that was presented yesterday showing ETF and index options bid-ask spreads up by some number like 100% from, I think it was from October to January, or maybe it was from September to January, even before the events of February. Excuse me, I'm going to correct myself. It was from October to April, but skipping over February, which had that huge spike, we still saw that severe widening. We also have data internally in my firm that indicates, just looking even during the period when volatility was still persistently low, so looking at Q3 of 17 to Q4 of 17, index option execution prices relative to a fitted theoretical value look to have increased by about 30%. In SPY for spreads, which takes away some of the delta noise, looked like it was about 40%. And that was at a time when the VIX was at record lows. So even factoring out heightened vol, we do see these liquidity constraints. A lot of the issues that go to that, and we'll talk about some more of them, I suspect maybe later in the conversation, are somewhat controversial. The reason that we keep turning back to the capital issues is they're really not controversial. I think everybody agrees that there is a solution. We should not be assessing capital charges for liquidity providers or bank clearers in this way.
But if you do that,
go ahead.
If the risk-weighted asset and having a put spread, a $5 put spread that's worth more than $5. But then when a regulator comes to you and says, well, on this closing day on February 5th, this put spread settled at $95.
Right.
If you take the long short and it's zero bid at 100, and the banks are going to market to there, and you're going to have to come up with the capital to do that. And if you can't come up to the capital to match that crazy valuation, then they're going to blow you out, which will make it even crazier, it gets synergistic and moves like that. So we can go to the regulators and say this is nonsensical, but we have to be prepared when they throw it back at us and said, you guys dropped the ball here, because it wasn't nonsensical. It was very real like I said, having lived at Wolverine and Credit Suisse, we all marked the theoretical anyway, so it didn't really matter. But then when you move into the real world and someone says, I want to redeem $2 million out of your fund on today's settlement prices, and you go, okay, you just paid $95 for that $5 put spread.
Yeah. Can I ask, just playing off of that, if, hypothetically, if there was sufficient capital capacity and the market makers could function without that kind of constraint on them, would the spread still on that day have been that wide, or would we have better prices at the end of the day where you wouldn't have seen that?
I'll bet you. My theory is it's become so expensive to be a market maker that we've driven market makers out of the business. Yeah. And if you speak to current market makers, they'll say, I'm already in the business and I've spent so much money between regulation and high-frequency trading and keeping up with the latest server that I can stay in it, but getting into it. And you're seeing the number of people that make markets in single stocks outside of the top 10 or 15 names, it's very few. And that's because it's so expensive to do between the risk-weighted asset fee and then exchange fees, and then on top of that, the regulatory fees. As you drive less and less people, you drive more and more people out of the market, you have less people playing in it. So it's That I think is the problem.
Yeah, if I were to try to summarize, right, it sounds like on some instances the capability to really price and compete has never been better in normal circumstances. Because of the regulation, because of some of the other issues, capital charges, costs, we're losing participants, and the market's starting to get fragile. It's starting to show some of the cracks. And in Mauricio, thinking of it from a clearing bank perspective, I know coming at it from the OCC's perspective, we have 3 clearing banks that provide the lion's share of guarantee for all of the market's liquidity, which is scary.
Yeah, I mean, I couldn't agree more with Dennis's point about the cost being exorbitantly high for market makers, but I think the same applies for clearing firms, right? It's extremely expensive to service this space. It's extremely difficult, and it takes a lot of capital. Even if we were to dramatically improve the capital rules to be more risk-based, it's still going to be a different regime than it was a few years ago. That's not going away. So as much as we're seeing less and less market makers, the barriers to entry for a clearing firm are even higher, in my opinion. And if we talk about the effects of February, I think, don't want to put you on the spot, but I think the effect that this had on the clearing fund at OCC, that's also a massive tax to being able to be in this business and to being able to adequately, provide enough capital so that there could be enough liquidity as well.
That's great. I think when we think about the events of February 5th and the impact on OCC and the ecosystem that we've applied, the regulations are tough. They're challenging. They're very prescriptive, and there's often very little flexibility to take the type of actions that are right in the sense of systemic perspective. And so a lot of the rules are designed towards making sure you have sufficient credit and liquidity resources for the event. At the same time, during events like February 5th that are outlying events, you need to have the flexibility. The regulations need to be flexible so that you can take the right steps to mitigate what I would call creating disruption into the markets. And so you need that have flexibility to apply some judgment in those extreme circumstances to do the right thing for the overall market. And so I think that's one of the things we took away as well.
Yeah, I think it was interesting. I think it was a gentleman from SIBO yesterday who was talking about creating an options committee that would deal with these issues. And I think all of these regulatory changes the last couple of years, at least for us, this has opened our eyes to the fact that we are not representing the potential consequences of this properly to regulators. We're very reactive, and that's just simply it's all our responsibility, and it's what we're doing is just not good enough, right? We are not telling regulators with clarity that being able to react to an issue in the clearing fund should not take 6 months to a year. Mm-hmm. We need to be more nimble. And look, I get it, right? Bank of America, Merrill Lynch decides that it is probably not an example of nimble, but we need to be a lot quicker in how we move as an industry, such that people like Dennis are not going to feel, the effect of us not being able to make changes that would improve liquidity, that would improve transparency. Yeah. That's a key thing.
I think it's also excuse me, it's also important to always bring the point back to, and Dennis was speaking about some issues that are a focus from an end user standpoint, and always thinking about that end user, thinking about the ultimate customer.
That's right.
Our industry was built on the idea that market makers provide liquidity, it's advertised to the world. That is our advertisement to the customer. That is what brings customers into the listed markets, is the certainty that I'm going to be able to trade at this price or that price, pay a reasonable bid-ask spread. I generally know what the cost of liquidity is, what the cost is going to be to get out of a position once I'm wearing it, that I know I'm going to be able to do so at a fair price. And so I think it's important that, I can complain about the issues faced by market makers and Mauricio appropriately about the challenges at the bank, but ultimately what's in all of our interest is solving these problems for the reason that the end user needs to have a better experience. And so to the extent that we see end users having to pay worse prices, or the widening of bid-ask spreads, which we've seen as a long-term trend, over the last 6 years or so, effective spreads in the top 500 classes of options have widened by something like 30%. and the displayed size at the top of the NBBO has been reduced at the same time. Again, even if you just look at data through the end of 2017, as the vol was getting lower and lower and lower, and you would ordinarily expect more liquidity to be available in volatility normalized terms. The result of that is a worse experience for the customer. And it's an issue that transcends just the options markets. You know, sometimes when we talk to regulators outside of our direct space or to staffers and congressional members on the Hill, there's less familiarity with the options markets than there are with the equity space, where there's a little bit better connection understood to capital formation. And retirees are investing, and Mr. and Mrs. 401k are in that area. But when we talk about the options market, ultimately we're talking about the same audience. We've got IRAs who are trying to do overwrites. We've got our pension fund managers who are trying to do overwrites and buy right strategies. But also there's just the overall knock-on effect where if someone's used to being able to protect themselves, they're used to being able to grab those puts or do that collar when they need to offset their long position, and all of a sudden they can't because, to Dennis's point, they look at the markets and the prices are wonky or the bid-ask spreads are terrible. There's a risk that they're just going to liquidate instead. Yeah. And that could turn a 2% shock into a 5% shock very quickly.
Mm-hmm. Yeah, I think we have to be careful, though, as to who we listen to. Because the situation we have right now, we've grown volume in the options industry. I think for a long time we were listening to people saying lower fees, tighter spreads, and we chased that audience. And we were successful in expanding the business in that direction. I think, unfortunately, what we're saddled with now is a retail-focused set of rules that doesn't fit with the institutional space. And the growth is going to come, in my belief, is from the institutional space. I mean, I can trade complex order spreads on my iPhone. I go to somebody who manages, a $70 billion state pension fund, and they are still using programs written in COBOL and Fortran and clearing processes that are antique. So getting them on speed and their sensitivity to bid-ask relative to what they've paid in fees to a lot of their managers is not that much, and the lack of frequency of trading that they do. We roll our portfolios like once every 3 to 5 weeks, our options portfolios. Mm-hmm. And they like that because we don't overtrade the portfolio, and there's an understanding of what we do. But listening to, of course, listen to me, this is what I want, but I've seen us, in my Credit Suisse days, there were times where we would have to put trades up on retail markets for institutional hedge funds that were clearly shouldn't have traded there. And then, one of the problems with liquidity is the banks have left the business. Yeah. The investment banking, their ability to deploy capital in those areas, has evaporated. And they were the ones who squeezed the CTCs and the Wolverines and the Timber Hills out of the business because the bid-ask got so tight. Mm-hmm. Now they've left. Now we're left with very few. So they left town, and there was always wealthy individual floor traders, then to trading groups, and then investment banks, and now investment banks have left. And it's some synthetic high frequency trading or our market making groups right now. Yeah. Yeah. And they're built to handle the retail flow very well and be profitable, and they should make money doing that. We have a regulatory that says, I know the market on the screen on this is 35 cents, bid at 36 cents. You want to sell 50,000 of them, that should probably come at 30 cents or 28 cents. Mm-hmm. And the regulators go, well, no, that's not fair. Mm-hmm. So the people say, well, then I'm just not going to do it.
Yeah, yeah. It's all the unintended consequences of the regulation.
Of who you listen to.
Yeah. We've been talking a lot about RWA, and I know that's not the only issue, right? While that might be the most pressing issue, there are other issues. Mauricio, what's top of mind outside of RWA?
Yeah, look, we have a lot of clients here, so I know that I'm going to bring up a subject that people don't like us that much about. So yeah, balance sheet. Balance sheet is a massive concern for banks, right? If you look at all the ratios that came out of regulation after the financial crisis, all of them are meant to address banks having enough capital, and so many of them are based on balance sheet. And for us, the availability of balance sheet, it's such a difficult process. It's such a competitive process. So I think if I were to say what is restricting market makers today. Certainly, us having constraints on balance sheet translates to the market making community having constraints on balance sheet. And look, for what it is. It just has to drive the conversation between clearing provider and customer to a different level. But to me, aside from all the issues that we've talked about on RWA, I think the balance sheet items are something that are very difficult for this space.
Steve, what other risks are you seeing?
Yeah, I think a lot of them come down to a point that Dennis made earlier about the barriers to entry, which also translates into barriers to expansion, even for established participants. I mean, we've talked at this conference over many, many years about, and including, came up yesterday, exchange fragmentation. There are more and more platforms. That translates into more and more places where orders may end up not getting the best price in many cases. We've got an additional trading floor that launched last year. There's no reason to launch a new trading floor in the modern environment other than to provide a venue for a broker to take an order that he prefers to internalize than potentially trade with a third-party market maker who may offer price improvement because of some adverse incentives that unfortunately exist in the market structure. So that's unfortunate. And a lot of it comes down to the cost of technology. There's an unbelievable expense that's incurred by liquidity providers on an ongoing basis to become competitive, to remain competitive. We see it's interesting that we live in a world where I think everybody would agree that it would be toxic to allow market makers and professionals to compete on the basis of providing price improvement at the level of a millionth of a cent, or at the fractional contract level. I can step in front of you because I'm willing to do a millionth of a cent better on that trade than you are. But we allow exactly the same thing with competition now stepping into the world of nanoseconds, which ultimately doesn't benefit the customer and creates a cost for the industry, only benefiting the people who have the fastest computers. And we certainly support competition across a variety of axes, including on the technology axis. But at some point, the cost can go to infinity, and all that does is prevent liquidity providers from being able to focus on pricing and risk management, which ultimately benefits investors. So putting all that together with the market structure concerns, with the challenges of ordering across, we're going to have, 16 and 17 exchanges. It's more difficult than it should be to provide that better experience for the end user.
It sounds like we're between the unintended consequences of the regulation, the hyper competition within the market, the barriers to entry, and the cost. We're starting to now drive away a lot of our liquidity providers and those potentially the technology and the more quantitative high-frequency trading shops coming in and then exiting is creating some real damage. Dennis, when you look at that entirety of that issue on the listed market, and you're also looking at the OTC market. Earlier you talked about the OTC markets right there. How much are you seeing that the accumulation of these issues is driving you more towards that than maybe 5 years ago, or is it not?
I spoke at this conference, I think, in 2008 when I was at Credit Suisse. It was at the height of Lehman and everything going pear-shaped. And I kind of jokingly said, and it's been 10 years since you've asked me back, I think. I jokingly said that, well, you guys think you have this OCC, and Credit Suisse is a very sound bank. It's more sound than the people who make up the OCC. So when I was talking to people, they were like, we don't want to trade with the OCC. We'd rather just trade OTC with you. And then I was promptly escorted off the stage. You said there's only 3 banks clearing most of the liquidity providers right now. Like, to me, that's shocking to me. I didn't know that. But then the other thing I look at is, if we look back over the last 7 years, the biggest growth we've seen in the business has come from an area where I didn't think you would see it, but the market did correct itself, is the short volatility play. The number one institutional play out there with, I would say $200 or $300 billion tied to it is the selling of volatility. It's selling kurtosis. It's selling put spreads. It's overwriting by selling calls. It's collateralized put selling. That's the real growth area in the business right now. So it's surprising with all of this volatility that's been for sale, and then in the growth of the ETNs, which them going away is interesting. I mean, if you look at U.S. vol versus European vol right now, it's the most it's ever been inverted. And that's strictly because of the dislocation in the U.S. market right now. So I don't know where the growth's going to come from. It could come from continued seeing people sell volatility. Do I think we'll see the VIX down at 9 again? People were still selling volatility with the VIX down there. The challenges are, I believe, I've met with one consultant, their head of research, they're a big consultant. They have $600 billion tied to long-short equity hedge funds, which most long-short equity hedge funds, hopefully no one throws anything at me, are selling some sort of tail, right? They're basically selling optionality, and you can look at it statistically, and it's kind of random walky, but eventually they try to outperform the market by a certain amount. He wants to take, if it's $600 billion, he's like, I want to move 10% of that over to derivative-type strategies. Mm-hmm. That's $60 billion. From one consultant in one sleeve is $60 billion add to the business. So I just think that I don't know where this growth is going to come from, but I know if he wants to move $60 billion over and somebody else wants to do it, you could be looking at $5, $6, $1 trillion of assets moving to derivative strategies. Mm-hmm. We have to make it when that does take place that the market can handle it. We can't have $1 trillion of assets of people selling volatility or buying volatility, who knows what they use it to do, all funneled, jammed through three investment banks, right, who have more and more balance sheet constraints. So it's like, once again, I go back to my roots. I do think there needs to be profitability for the people who provide markets, not just a few. Like, it needs to be opened up a little bit.
And the incentives, I completely agree with that. And it's really unfortunate to hear that anecdote, right? Because it's an opportunity to grow the business, but the structure doesn't allow us to take advantage of it collectively. And
I would say that I'm worried that the structure, you can add $60 billion tomorrow and the market will eat it.
Sure.
But if you add $2 or $3 trillion to it, I think we would be struggling. Yeah. But then it's who you listen to. If you listen to me say that, but then the person who comes up who runs a retail book is going to say something entirely different.
Yeah, and I agree. We've often said that retail has never had it better, and that may very well still be true. I'm interested in what my friends on the retail side have to say about it. But from the standpoint of being able to handle the larger orders and being able to handle them on the listed markets in a way that's attractive to the people who control those orders, ultimately, I do think that's a concern today. And we experience it now as a market maker. We'll get calls, hey, I want to do this trade, I want to do that trade. We say, okay, we'll do it at this price. And then occasionally we'll get the call back shortly thereafter saying, oh, sorry, yeah, actually I have to do this OTC for one reason or another. Often it's about concerns about information leakage, or very often it's concerns about costs, and that some of the costs in some of these products are on a listed basis, are assessed per contract, whereas some of the fees on an OTC basis may be on a notional level. And so there can actually be a cost arbitrage to not do these trades on exchange, which is something that I think the exchanges really need to be looking at in order to allow us to continue to grow.
Yeah, the regulators used to roll their eyes at me all the time because they'd say, if I trade this OTC, and I know the financial motivation of my client. He just wants to buy puts on his overall portfolio of, he wants to buy $500 million worth of puts or $1 billion worth of puts. Okay, well, I'm going to go sell futures. I'm going to view out my futures over the next 35 or 40 minutes. I'll tell you where I'm filled on the futures. We'll delta adjust, and then we'll trade it OTC. You need to have the ability to do that in the listed market. And then the regulators say, no, that's preemptive hedging. You're getting in front of, and it's like, okay, then my customer and I will just go OTC because we're both winning. Yeah. And your regulations are preventing us. And I'm not saying you shut the floor or the exchanges out. You present it tied up delta neutral. If people want to participate at that level, then you let them.
Yeah. It sounds like, the unintended consequences of the regulations and looking at different aspects of the regulation, what's the regulation trying to promote, is really acting counterintuitive to the coming out of the financial crisis of really trying to drive more of the OTC transactions into a listed, transparent, secure environment. And so what we're hearing is a lot of that is really pushing it the other direction, especially with the capital issues and the capacity issues.
John, before you move on, look, I think one positive aspect of having fewer market makers and being able to support that growth is now you're talking about extremely sophisticated, well-capitalized firms that have a very deep expertise in these markets and it could actually be there for that growth. So as much as having these very high barriers to entry, I am optimistic about if there was $60 billion of assets or whatever that may be that came into the market, the liquidity provider community today is very well equipped to actually handle that.
I agree.
Let's try to turn it a little more positive on what we can do and how we can change this direction. We're all negative Nancy's right now, but I think RWA, Steve, your firm's very active, OCC, CBOE, Mauricio and BAML and Goldman, very active in trying to facilitate change rulemaking, potential legislation. So I think there's still a long tail on that, but there's a lot of focus on that. Next thing down, what's the next thing people should be really focused on in trying to either lobby support or try to affect some change? Who wants to start?
Please go ahead.
An element of self-policing. I mean, at times I go in and if I'll be pitching to a fund administrator and I feel like I was preceded by an older brother who did a lot of drugs and beat up his teacher and did a whole bunch of stuff, and they walk in and they're like, "We know about you. We saw your older brother." We have to make sure we do have a black eye from the ETN. What happened? We need to. That's what we have to. There was a fund that blew up. I can think of 2 or 3 funds that had 1 by 28s on, and they blew up. So that kind of measuring that, how does that happen? And that's what people shy away from our business because they see it as this mysterious thing that they can't handle. Mm-hmm. So what do I look for? Yeah, if growing the business and being positive and growing the business in rather straightforward, easy to understand ways and trades that the biggest thing is collateralized put selling. That's really advanced in the pension fund and endowment space right now. And it's great. And they want to look towards it because they're looking for other places. There's tons of money out there looking to do different things and see how we handle a rising rate environment.
Mauricio?
I'll go very specific on this, right? I think there are many small changes and very logical changes that need to happen in this industry that will make it a safer, sounder industry. Give up process, CMTA process, all of those things should be streamlined, should be modernized. We have rules that, I'm not even going to call it regulation, it's rules that don't address the risks that are there for the clearing member in being able to provide services like that, right? So common sense steps, and I'll echo what I said earlier with regards to timing. This shouldn't take years. I think if we all sat in a room and discussed about why the give-up situation is the way it is, we would all be nodding and saying that doesn't make any sense, let's change it. But we've been talking about it for a number of years, and now we're at the cusp of getting it done, but it's taken a couple of years when it should be very quick.
Yeah, I completely agree with that. Eric Freight from SIBO spoke yesterday, as Mauricio referenced earlier, about getting a group of folks from the industry together, including the exchanges, with the blessing, or at least without the objection of the SEC, in order to have a joint conversation about some of these issues that would allow us to grow the business. I think it's an excellent idea. It's incredibly important. I really would like to see that move forward. A lot of the challenges that we're talking about, the CMTA give-up issue is a great example. That emerged from exchanges, unfortunately, for reasons that I totally understand. I know what it's like to be at the exchange and have to make these decisions, but you're trying to compete with each other, and you want to make sure there aren't barriers for your customers to get trades done. And next thing you know, you've got these very kind of loosey-goosey give-up rules. That's a technical term. Give-up rules. The same thing is true with the proliferation of auctions and the challenges that's posed for liquidity providers by disincentivizing posting displayed quotes, even for those smaller orders, which now we actually see resulting in effective spreads that are worse than they were before. And it's because the exchanges are competing for that consolidator internalization business. And I think everybody would privately say, yeah, it'd be great if we change the way these things work to prevent these adverse incentives, but I can't do that by myself because then everybody's just going to route to the other guy's platform. Yeah. So getting everybody to talk about that and say, how can we fix these problems collectively to avoid this sort of tragedy, the commons issue, where everybody just throws their trash in the backyard and pretty soon the backyard is gross? Sorry, I didn't rehearse that metaphor. That's the best I could come up with on the
prepared,
spot.
Right?
Yeah, we discussed this in the prep call. Yeah, it's great to have that conversation, and hopefully we can get that going and get some good results out of it.
We got one question from the audience, and the question is really focused around the concentrations of volumes and the near-term expirations and a very few number of top names. And as we see those types of concentrations, what do we think that means really as we try to go out further in the term structure and creating liquidity at longer dates? Steve, do you want to start there?
Do I have concerns about it? Certainly, yeah. I mean, we'd like to see a robust liquidity profile that exists across the entire term structure. It's been great to see the success of short-dated options over the last half a dozen years or so. It's a product that clearly met a demand niche that wasn't going filled before. But a lot of the issues we've spoken about earlier in the conversation would go to encouraging continued strong liquidity provision for those longer-dated, less liquid options that get stuck on your sheets and that you have to be able to hold and capitalize for an extended period of time.
Mm-hmm. Mauricio?
From our standpoint, look, I used to be on the risk side at BAML, and I don't want our clients holding anything that they can't get out of, and that just if there is no liquidity in a 3-month option, I certainly would prefer that to change. Yeah. So it's very simple. If everything's going to the weekly options, then we as a bank will be concerned on the counterparty risk that we're trading if someone is trading a year-long option. So. It does have an impact, but if it serves a purpose in the market that, as Steve said, right, they've been immensely popular. It's difficult to assess whether this has been positive or not.
Dennis, as you think about your own investments and being able to execute on a 1-year, 5-year type of hedging strategy.
Well, I'll keep it quick and just kind of to the point. It's what people want. When I joined Harvest 5 years ago, it was $3 billion of assets in that short vol bucket. That bucket, which I don't trade, has gone from $3 billion to $12 billion. I think it has more to do with interest rates than people realize, because these yield enhancement strategies in a zero interest rate or arguably negative interest rate environment were very popular. So that's why you saw that. And people say, I want yield, I want short-dated options, they'll say, I want short duration options, because they think like bond traders. So that's why we've seen that crowd into the space. It grew, it got really big. The indexes started listing weekly options so they could spread their positions out over more expiries, which was convenient. So that was the one driver. Do I think it's going to change? It's also a uniquely U.S. thing. So Europe, if you look at Europe and Asia, they tend to trade much longer dated options. U.S. investors are very delta-centric. We have a much larger appetite for risk. So directionally, we'll sell calls or we'll buy calls in 2 or 3 weeks because we want to see the result. It's grown because of the yields. I think as you see interest rates go higher, more structured products will come online. That interest rate will give you a yield. You can then use that yield from that rate, but you're going to have to be living in longer dated options. So I would actually say over the next 5 years, if we continue to see interest rates go higher, you will see more structured products come out of the banks and more of a demand for longer dated leaps and less of a demand for, I'm looking for a 2.5% yield, I'm going to invest in this overlay strategy.
Yeah.
I mean, I hope I'm wrong. We have a lot of money in the overlay strategy, but yeah.
Great. As a wrap-up, I'll say I am surprisingly optimistic after this panel that there is growth opportunity, significant growth opportunity for us. I do think we have a strong grasp of what the issues are that are kind of containing that growth. And I also see us as an industry better mobilized, better coordinated to try to affect those changes. So I'm generally optimistic out of this. Thank you.
Thank you.
Thank you, guys.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.